please remember, in such an arrangement, parent-subsidiary arrangement, you cannot avoid that they are doing business between them. For example, if you think Taxation, you have Taxation Motors and Taxation Service Station. So the services of the Taxation vehicles, they will do it in Taxation Service Station. So that type of intercompany trading. So for when a Taxation Motor one vehicle is being serviced by Taxation Service Station, this is a sales for whom? Taxation Service Station, and this is expense for Taxation Motors. So now first point is you have to find out business is happening from which point to which point. If any business from A to B, meaning parent to subsidiary, we call it when trading takes place from parent to subsidiary, we name it downstream, from top to down. So when trading takes place from subsidiary to parent, we call it, what do you think? What is the word? Upstream. Exactly. So either it's a downstream or an upstream. Let's now try to understand downstream. Let's say A selling goods to B, sales 1,000, cost 600. So how much is the profit?
390.
1,600. 600. Sorry.
400.
400. Profit is. Now A sold these goods to B. Now we know that these two are group. So when I am selling items here, is the item has gone out of this circle? No. Correct? So now this profit A is making from whom? B. Same group. Now they also say that how much is the cost to B? Cost to B how much? Cost to A 600, cost to B
They give a full price, 1,000. That means 1,000.
1,000, exactly. The cost to B is 1,000. Correct? Cost to A how much? 600. Cost to B 1,000. Now they say that in the warehouse of B, 25% of the stocks remaining. Stocks. How much is remaining? 25% is remaining. Meaning 75% of the stocks has gone out. Correct? What was the price B charged to outside customer? They have sold 75%. 25% is remaining. Now 25% is how much then? 25% to the cost to be how much? 25%. 250. Now go back to IAS 2. Inventory should be valued at cost to NRV, whichever is lower. Cost to group how much? Total. Now we are having how much?
1,600.
150. 150. Understood? So the 25% of this. Am I right? So that is 150. So there has been an overcharge of how much? This is like a additional profit that is been built in this here. This we call it unrealized profit. For the group, is it okay to say that my total profit now 75% I sold now? So the profit that we are going to claim 300. I mean, we are claiming how much in the books of pay. What is my total profit I am claiming? 400. But how much I should actually claim? 300.
The basic mechanism is the other 25% is with us.
With us.
How can we, in our total consolidated, we can
Definitely.
show
So, what we need to do is all unrealized profits should be removed. Should be removed. How? Now, inventory in the books of the what do you call? In the books of the subsidiary, and profit in the books of the parent. Correct? Now I have books of parent and books of subsidiary. Correct? Here I have my group return and here I have my inventory. Correct now? What are the total inventory that I have, including this particular inventory also. So what I need to do now, normally I will have my profits, total profits. This profit, yeah.
Sir, can you explain that how the inventory is in the books of subsidiary?
Sir, okay. Now I am selling goods to B, no?
Yes.
So in the warehouse of the B only, the goods will be sitting. So whatever the goods in the warehouse should be the inventory for the subsidiary.
Yes.
That's what I am saying. So here, double entry will be, they will debit the purchase and credit payable. Whatever they have done purchases, remaining is coming to inventory. So, inventory is normally. Now, how much is unrealized profit?
100.
So, I transfer to unrealized profit. Coming from here, group return line. Remember, after this no double entry, it's just a set off. So what I do is offset. The same amount, whatever the amount here, you will take it. Now in this example, it is 100. So this will become 0, and then again here, I will offset the same, that 100, and the net amount will go to balance sheet. So this is on which method? Downstream. Upstream is slightly different. Before I go to upstream, I wanted you to make sure you understood downstream. Any doubt? Please let me know. What is the story? Parent company, subsidiary company. Parent company selling goods to subsidiary company. Parent company making an additional margin as a profit. Here again they will use the complication of markup, margin, percentage, fraction, everything they will use. So you got to be careful with that. So they will transfer, they will then selling this. Now at the time of consolidation, we have to arrive inventory at the cost to the group. So whatever the additional price we should remove. Because there is no use of keeping it. That's what we are doing here. So this is downstream. So if can I go to the upstream now? Upstream is what? subsidiary is selling goods to parent. Now remember, this not always 100% ownership. Sometimes 100%, sometimes 80, sometimes 70. That means there is non-controlling interest shareholders coming in. Now let's say the same sales 1000, cost 600. So profit how much? 400. 25% of the stocks here. So that is 250. Cost to P. Cost to parent. Cost to subsidiary is 600. Cost to parent is. And then let's assume 80%. No, let me make it 75%. 75% parent ownership. 25% subsidiary. Now what you going to do?
So out of 300 only you can manage.
So now what you do is you calculate the unrealized profit. How much is unrealized profit? 100. So unrealized profit how much? 100. Now the double entry will be you debit group retained earning 100 into 75%. So that is 75. You debit NCI 100 into 25%. That is 25. Provision for unrealized profit. This is the difference. In here what we did, I debited to entire 100 here. And I credited that entire 100 here. So debit, group, retained earning, and then credit to provision for unrealized profit. But down here, we have an additional item. We need to take a portion from the non-controlling interest. Clear? So now we move on to the question. They know now. Okay, so we have to prepare the entire question. So we'll try that. Go through this question with activity number 4. P company acquired 60% of the share capital of its company on its incorporation. So the date of acquisition and the company information same. The statement of financial position of the two companies as of 31st December 2018 are as follows. The fair value of the non-controlling interest in S company at acquisition was 4,000. S company sells to P company at a profit margin of 25% on selling price. At the year end, 12,000 of the goods that P company had purchased from S company still remained in inventories. Prepare the consolidated statement of financial position as of 31st December 2018. First step, group structure. Kindly do the group structure. Can you stop the video, please? Activity number
4.
page
435.
Which company is acquiring which company?
P is purchasing S.
Yeah, P is purchasing. P company, right? %60. You know, do you know?
6.
6. That's one. Then
No revaluation.
now, if you look into the return earnings, now they say acquisition and incorporation on the same day. So could there be any pre-acquisition reserves?
Yes.
No. All. So return earning is 0. Meaning at acquisition. Huh? And then NCI?
40%.
No, that is 40% okay. So the valuation of fair value of the non-controlling interest in
4,000.
4,000. That is 4. Any other information we can pick? That's all. So this is the information to calculate now. Work into.
From where 4,000 is?
Second mistake.
Now we work out the working to calculation of subsidiary share capital how much?
10.
So goodwill is 0. Correct? Now, before we go to the consolidated return earning, we have to work out the unrealized profit. Next working is
Number 3.
working 3, yes. Unrealized profit. Now please tell me, is it downstream or upstream?
Downstream.
Steel,
No, purchasing. No?
yeah, upstream.
Upstream. Sorry. Yes. Steel selling to
SC is selling goods to B. Steel sell goods to P at a profit margin of 25% on selling price. See again, examiner is so kind on you. Why? Profit margin, the word when they say word margin, immediately you should think it is from the selling price. But he is saying here on selling price. So that's a double qualification for you. Now, 12,000 worth of goods are there. So how much will be the unrealized profit then?
9,000.
Huh?
3,000.
Into 25 over, this is 100, correct?
Yeah.
How much?
3,000.
3,000.
Now, double entry, debit, group, return earning, how much? The 60% of, the parent ownership holding. What is the parent ownership?
60.
60%. So 3,000 into
60.
that is 1,800. Debit, NCI, 1,200. And credit, provision for unrealized profit. Clear? Okay. This is working number 3.
So debit convention, debit.
Last one.
Huh?
Last
Profit
one.
from-
This one provision for unrealized profit.
The first one,
Group return earnings. Now we go on to working number 4. B and S as per question. How much? What are the written engines as per question? 147 and 73.
How much is an unrealized profit?
1 second. 3,000. Pre-acquisition profits. Do we have?
No.
No. So that is 0.
Working for us.
Yeah. How much is unrealized profits in total?
3,000.
So what is the answer?
7.
70. This is known as post acquisition net return after the adjustment for unrealized profit. So now transfer to group. What is the percentage
60,000.
of 70? How much?
42.
Transfer to NCI. How much? 70, 40%. Which is?
28.
So this answer should be 0. And this will be 147 plus. Oh, sorry, here I made a mistake. Yeah, 147 plus 40.
189.
189. Now, NCI. At acquisition, how much? At acquisition is this. This number. Which is? So, how much?
72.
Now, I want you to, I think, I believe you have a doubt now. How this double entry working? I wanted to clarify that to you. See, I am subtracting here 3,000, which is this total. And then I am transferring 60% of this. But I could also do, I could transfer 60% from here. Can you calculate for the sake of understanding 73 into 60% how much?
$43.8.
43.8. And then I should subtract 60% of this. That is how much? So if I subtract 1.8 from there,
42.
so you could do this way or that way, but the best recommended method is what I have done. Okay? Same thing you can also work it out here. Now, 40% of 73 minus 40% of 3 will give you 28. Now 73 into 40%, whatever the answer you are getting, minus 3 into 40%. Whatever you are getting, this answer should be this. Check. Same answer, no?
First one, 29.2.
Okay. and 1.2.
1.2.
So 29.2 minus 1.2 is 20. Clear, no? So now we can prepare the.
Can you erase those things?
You want me to erase this?
Yeah. And the round down and this.
Okay. Property, plant and equipment. How much? 200 and goodwill investment. Investment no need. Goodwill we have
Zero.
No,
zero. Colors. Current assets.
Zero.
Inventory. How much?
Zero.
22 plus 18. 22 plus 18. Please make there is unrealized profit in the inventory. So we have to remove 3. That 3,000, they have overstated their parent company, this 12,000. At the selling price, we have to reduce it to this, we need to take off this 3,000. So, minus 3.
Why minus 3?
Whether if you, I will show you the double entry before. In the previous note. See here. Books, see this. From the inventory, whatever the amount of unrealized profit, you have to take it out.
Okay, but 3 from here?
Yeah. See, double entry, now you need to think about double entry. Now I only removed from the profits.
Okay.
So I also need to remove from the assets. So
Minus 3 or minus 30?
minus 3. Why 30? The unrealized profit how much? From the 12,000, 25%. How much is that?
12.
1,000 into 25%.
Details.
So this you need to take it up. How much?
So, 37.
30?
So,
So what is the next item? Receivable. Another good point. See here, we need to pay parent, that means subsidiary need to receive from the parent 30. Can you go to the payables and then you, the parent company need to pay 30. This you call it intercompany payable. This also need to adjust. So what you do now? Receivable, receivable from P 30, I will minus 30. So, and then
Others. Receivable others. 96%.
yeah, receivable others is fine. So, so next line is others. How much others? 96 plus 29.
125.
How much?
125.
25. Cash.
4 plus 50.
4 plus 50.
90.
What's the total? So I believe all of you understood why I subtracted this.
Yeah, 180.
Intercompany. How much? 181.
81.
So can you take the total of these two? 250 plus 181, how much?
Four.
That will call
431.
total assets. How much?
431.
431. Then you have equity. Equity. Share capital. Only the parent company share capital. Return earning, you have to take the answer from our working. 189. So 289. NCI. 32, right? So 289 plus 32, how much?
320.
21.
21.
Say that?
289 plus 30.
Correct, no?
Yeah.
Okay. Then liabilities. What liability we have?
Payable 30. That was we have
Yes, payables. Yes,
Steel not will come.
minus
Sure,
20, 0. Others.
51 plus 59.
21 plus 50.
Double 10.
That is 110. What is the total? 400?
431.
400. Is it tying up?
Yeah.
Total. 50. Let's go to the next question.
Can you send that to me? Can you send that?
Share is not. I am sharing in the group.
I'm not in that.
You are not in the group? Okay. Everything in my tab, don't worry. You have everything.
Rest of this one.
Yeah.